So here at Rivkin, we have a whole variety of different investment strategies that are designed to suit all types of investors. If we take a look at our flagship product, that's the ASX event portfolio. This is really for investors that have a low risk tolerance, so they're seeking lower returns as a result. And to do that, we look at market arbitrage opportunities and takeovers. And really, this acts as a great portfolio diversifier because the returns of this strategy move in a very different way to the market. So it's very appealing for those investors that are seeking to avoid that equity market volatility that we see from time to time. Additionally, a real benefit of this strategy is that those distributions are often fully franked. So that's important if you're one of the many investors that use a low tax paying vehicle. It's very common here in Australia to use a self-managed super fund. You're actually benefiting from that tax rate differential. If you're an income-focused investor, then we have a couple of options for you as well. Firstly, our ASX blue chip portfolio. This is in the equity space seen as generally a lower risk equity type strategy. Within it, we're investing in large cap stocks. So these are household names, your BHPs, your Rios, your CBAs. So we're investing in established, highly liquid and financially sound stocks that pay a very comfortable level of dividend income. And again, an added benefit of that is that those dividends are generally fully franked or at a minimum partially franked as well. So again, very important for self-managed super funds. If you're a little bit more passive, then our ASX income portfolio might be right for you. This is more of a buy and hold approach. And within this portfolio, we invest in what are called hybrid securities. So they trade on the ASX just like a share, but they have more corporate bond-like characteristics. So they're a debt-like security. They pay an interest rate spread above the RBA. That's a very healthy yield. And again, we often do get franking credits associated with those. So if you're looking for regular income on a quarterly or a semi-annual basis, and you don't want to be too active in your investing, then that's a really good option for a lot of people. Finally, if you want to get more involved, you want to be more active, and you are looking for capital growth rather than income, then we have our two growth portfolios, one focusing here in Australia and the other over in the US. Now, they're run in the same way, just focusing on different markets. And to select those portfolios, we actually combine two systematic strategies. So the first focuses on a company's fundamentals, where we're looking at companies that have a high degree of financial profitability, and we're looking at high return on invested capital there. So really financially sound companies as well. And the second part is that we're looking at share price performance, otherwise known as momentum. So we're looking at stocks that are in a strong uptrend. And the reason we want to combine two strategies like that is that they move in a very different way. So what we're doing is building a portfolio that is seeking to grow your capital and therefore has higher volatility associated with it. But within the portfolio, we are creating a reasonable degree of diversification. But again, that's a strategy if you have a little bit higher risk tolerance.